Well, look at that. Small cap stocks are up almost 1% today because of this news. Weekly jobless claims just jumped to 231,000 for last week, the highest since August of 2023. You also had continuing claims, which run a week behind, increase to 1.78 million, up 17,000 from the previous week. And this jump to 231,000 for initial jobless claims is up 22,000 from last week. So this is a further sign that we are continuing to see weakness in labor markets. But this is not all bullish, and I will explain that here in this video. There is a potential bearish side to this as well that you do need to know. So first up, we have indexes chugging higher. Most notably, the Russell 2000 today is up 0.72%. If you track this using IWM, it's up almost 1%. But the Dow is actually the leading index today. The Dow is up 0.83%. The S&P is up 0.43%. And the NASDAQ, barely green, is up 0.22%. What's going on? Well, first up, ARM reported earnings last night. ARM stock was down about 9-10% in after hours trading yesterday. They're only down about 1.7% or so today. That is because ARM beat on earnings. Big surprise there. But they did give you a pretty low compared to expectations full year guidance for revenue, and that's what caused the stock to drop. This is also having a negative impact on Nvidia as well today. Nvidia is currently down about 2%, which is having this entire drag on big tech, which some big tech is doing better than others, but they're really just not doing that much today based on ARM earnings, which affected Nvidia. And Nvidia is such a large weighting now in the NASDAQ that 2% drop is having a pretty outsized effect on the NASDAQ. Consensus is the AI hopium, hypium, growth, whatever you want to call it, whatever terminology that you use, is still intact, but it's not nearly as strong as some people thought it was. We do still have Nvidia earnings that are not next week, but the week afterwards, which will be another big test to markets. But I think we have a pretty good idea now of what Nvidia is going to tell us. Also, keep in mind, Nvidia tends to move before earnings rather than after earnings. Sometimes Nvidia moves a lot after earnings, but they usually get that pre-earnings run up or run down. So these two things are the big things affecting markets today. And it's seen as specifically good news that weekly insurance claims for unemployment did go up about 20,000, 17,000 from last week. But it's not all great. There is, problems when it comes to that as well. And number one is, I want you to think back to 2022. What happened in 2022? Well, in Q1, Q2, you did have a technical recession, and that was because really inventories that were built up in 2020 and 2021, and then they started to get run down in the first half of 2022. That caused a technical recession, but demand was still good. The consumer was still spending money. What you're starting to get now is an opposite of that. You're starting to get a consumer that is slowing down. If you listen to Starbucks earnings call, listen to McDonald's, Home Depot, Walmart, doesn't matter what company it is, they're all saying the consumer's starting to show some weakness. They're picking and choosing what they're buying. They're sacrificing on some things to buy other things. Each company's going to have a different story, but they're all coming to the same conclusion. The consumer is slowing down. So it's not great when you see the labor market start to weaken, because that has an impact to company earnings. And if it weakens further, then next thing you know, you're going to be on the doorstep of a recession. Now, 2022, you really didn't have that. Consumers were still, again, spending money. Now, in 2022, stocks did poorly because the expectation was we were going to enter a real recession, an unemployment, consumer slowdown recession in 2023. By October, when markets bottomed, Bloomberg had a 100% chance of a recession in 2023. No wonder stocks fell, because you're going to want to sell ahead of that recession to get out. And that's what everyone does. So when the economy weakens a little bit, maybe that's not a, run to the exits kind of situation. If the economy continues to weaken from here, the labor market continues to weaken, people will start selling stocks. And long before you actually enter a recession, the markets will be in a recession. So if we think back to the non-farm payroll number that we just got last week, that came in at 175,000 jobs, where we were expecting 240,000 jobs. Let's say next month comes in the low 100s or the high, 80,000, 90,000 mark. Investors are going to start saying, oh crap, this could be a sign we're heading into a recession. So the closer you get to zero or negative, the worse off I think the markets could get. So just be very careful, because we've kind of been programmed the last couple of years to think labor market weakening, good news for stocks, when that's not really the situation. That's not the case. If it looks like we're heading into a recession, stocks will sell off. Now, the best case scenario for stocks is, hey, we get some weakening, inflation falls, and the Fed is able to start cutting rates. Take a look at what Tom Lee over on X just shared about CPI. This comes from Morgan Stanley. They say next week's CPI print, and they title this headliner, "The Descent Begins." Quote, "We forecast core CPI inflation fell to 0.29% month over month in April, 0.3% month over month cons, 3.6% year over year annual rate. Core goods remain in negative territory, and services come in lower with softer car insurance inflation." So they're expecting inflation is going to start coming down again, especially on your core CPI, which feeds heavily into PCE, especially core PCE. Tom Lee also shared this post to his X account from Julia Carano. I don't know if I'm probably butchering that hard. It says, "New car prices are falling everywhere, but in the CPI. There are some lags in the BLS data, but the tension is growing and more meaningful declines should show up in 2024. So car prices, new car prices, are falling, and that should start to help out CPI. But the biggest thing that is going to help out CPI that Tom Lee shared on his X account a couple of days ago is actually commodity prices, specifically oil. This is probably the biggest telltale that inflation is going to come down for April. Now, you started April with oil at about $81 a barrel. In early April, it spiked to 83. By the end of April, oil was at a low of about $77 a barrel. And actually went lower than that to start the first couple of days in May. So oil falling from $83 to $77 a barrel in the month of April should have a positive impact to CPI as well. Commodity prices tend to have the biggest overall impact to inflation because commodities are something that all companies are faced with as an input cost. If you think about input costs for companies, obviously there's buildings and loans and all of that. Keep that aside for a minute because that's going to vary company to company a lot. Every single company on the face of this planet is affected by two things: labor and commodities. Oil affects every single business in the world, not just the US, but every single publicly traded company on the US markets besides maybe a Meta, you could say, or exceptional cases. All of them are affected by oil as an input cost. Why? Because, maybe you make plastic water bottles and you actually have to use oil to make those. But besides that, I didn't produce any of this crap in this room right now. Let me just be honest with you. I didn't make these vitamin C tablets. I didn't make this Xbox controller. I didn't make this Roku remote or this Aquaphor for my chapped lips. I didn't make these peanuts. None of that crap I made, okay? Let me just be honest. I'm not making this stuff. Just like you are not. Your home has a bunch of different things that were not built by you in your home. You bought them from a store. That stuff was transported from a warehouse, a factory, to that store. So oil is an input cost to every single company. Okay, that's fine. So you have your two input costs, commodities and labor. Now, labor has obviously had some upward pressure. It's kind of starting to moderate based on the data that we've seen last month. Average hourly earnings came in 0.2%. Month over month, the expectation was 0.3%. That's still high, but it's starting to moderate. The factor in which determines inflation is economic activity, is the consumer. If the consumer is flushed with capital and they have money to spend on overpriced things, they're going to spend that money on overpriced things. Okay, simple as that. You give out stimulus checks, people are going to spend, there's going to be inflation. Anyone could have seen that coming from a mile away. Now, you're seeing people cutting back on Starbucks, on McDonald's, on Home Depot and Walmart, and picking and choosing what they spend money on. This is not the environment where you can raise prices if you are a company. So I think just the simple way to think about inflation is like that. Input cost and consumer behaviors. Input cost starting to fall with commodities, really across the board, but oil is the biggest one, so I like to watch that one specifically. Labor starting to moderate. The consumer definitely getting a lot pickier. So that's not a good recipe or backdrop for inflation. That's not a good backdrop for the bears that think we're going into hyperinflation. That's just not it. And the data that we got today with the weekly unemployment insurance claims, that really shows the economy is continuing to weaken, or at least the labor market is continuing to weaken. But again, for stocks, if the economy holds up good enough, that's going to be good, especially if inflation does fall. In a perfect world, you would want to have an economy chugging full steam ahead, maximum employment, and low inflation. That's possible, but probably not right now. You're probably going to get some weakening in the economy and the labor market, and inflation also falling. But that's good enough. And that's why I do think the Fed will likely start cutting rates by July 31st. And I think you guys want to be prepared for this, because current expectations are 30.2% chance of your first cut July 31st. So the base case from the markets is not expecting a cut July 31st. That's my expectation, is the first cut will be July 31st. There's a 69.0% chance of a continued pause in July. The markets are currently pricing in the first cut in September. I think you're getting that first cut July, and then you're getting the next cut in September. And by September, if the economy is looking like it's in a rough place, if inflation is falling from now until September, you may get a cut in November and also December. You could get 4 cuts this year still. Very possible. Very, very possible, especially with the data that we've started to get showing the labor market is weakening. If inflation also starts to weaken and come down, yeah, that's where things get much better for small cap stocks, interest rate sensitive stocks, as long as it looks like we're not going into recession. As long as we stay far away from a recession, stocks will do well, no matter what. If the economy were to drastically weaken, even if the Fed cuts rates to 0, but we go into a recession, stocks are still going to have a 20+% decline. So yeah, don't think that it's all about inflation necessarily. It's also about the economy and a recession. Think back to 2022 to refresh your memory if you would like. So for those reasons, I'm bullish. I think slight weakening is coming, and I think weakening in inflation trends is also coming, and that supports the Fed cutting rates in July. I think you want to prepare for that now because July is not that far away. Now, we do have some data coming out tomorrow morning as well. At 10 o'clock in the morning, you will get Michigan consumer sentiment. Expecting this will actually go up from 77.2 to 78 for the month of May. What's really important is 5-year and 1-year inflation expectations. So 5-year inflation expectations, the 5-year ahead inflation expectations, last month came in at 3%. For the month of May, you're expecting 3%. So not much of a change there. Michigan consumer expectations are expected to actually go up from 76 to 77.3. I think that's probably actually going to go down. Michigan current conditions is expected to come in higher as well at 79.5. Last month you came in at 79. I actually think that could fall as well. And 1-year inflation expectations are actually expected to fall from 3.2% down to 3.1%. So if 5-year, 1-year inflation expectations do fall, that's going to be great news for stocks coming tomorrow. Preferably consumer expectations, current conditions fall a little bit, not a lot, but a little bit, and 5-year and 1-year inflation expectations also fall. That could make for a really good day coming tomorrow for your small caps. 10-year treasury yields today are also declining about 2.5 basis points down to 4.45%. If you're rounding, you would call it 4.46%. That is also supportive today for your small cap stocks. Now, your latest AI investor sentiment survey as of yesterday came in at 40.8% of investors that are bullish, neutral investors at 35.4%, and bearish investors dropped big time, down to 23.8%. So the bulls are now in control, but there still is a lot of investors here that are pretty neutral on our markets. The percent of stocks above their 50-day moving average is also going higher yet again today, up to about 54.5%. 2.76% of stocks today are breaking above their 50-day moving average. So that is also just showing how broad the market rally has started to actually be ever since mid to late April. You've went from about 27% of stocks above their 50-day moving average to 55% of stocks above that 50-day moving average. And especially when you're seeing the Dow outperform the NASDAQ by such a large margin, that's usually a good sign of breadth improving in our markets. And as well as that, small cap stocks outperforming the NASDAQ is a pretty good sign as well. CNN's Fear and Greed Index currently sits at 43. Yesterday, it was at 39. If you break down the 7 components of CNN's Fear and Greed Index, you have market momentum that is still in greed territory. Stock price strength is in extreme fear. This measures net new 52-week highs and lows on the New York Stock Exchange. Stock price breadth is in fear territory. This is calculated off of the McLennan Volume Summonation Index. Put and call options, this is the 5-day average for puts to calls. That is neutral today. Market volatility is also neutral as the VIX is under its 50-day moving average. So actually getting closer to being greedy, if you will. Safe haven demand is in fearful territory. That is the difference in 20-day stock and bond returns, because bonds have definitely been outperforming markets by about 1.5% over the last 20 days. And junk bond demand is considered neutral today, which is interesting because you were previously in greed territory. So overall, it seems like sentiment's starting to get a little bit better out in markets today. And this Fear and Greed Index just actually ticked up to 44. Just as I was saying that. Let me know what you think about all of this information down below in the comment section. Hit the like button as well as subscribe to the channel. You guys have a fantastic rest of your day, and I will see you in the next one.